coming. Okay, good morning, everyone, and thank you for joining us. Welcome to the Tourism Industry Association of Nova Scotia's webinar on best practices in managing electronic payment for businesses. My name is Lynn McDonough-Hughes with TIANS and the Nova Scotia Tourism Human Resource Council, and I am pleased to introduce this morning's session. We would like to begin by acknowledging the traditional and unceded lands of the Mi'kmaq First Nation. We do this to reaffirm our commitment to improving our understanding of local Indigenous peoples and their cultures. From coast to coast, we acknowledge the ancestral and unceded territory of all First Nations, Inuit, and Métis people who call this land home. We are all treaty people. Today, we are joined by Ron Pizzo, partner with Pink Larkin Law Firm, Debbie Peverill, owner of Painless Financial Training Group, and Ryan O'Leary, owner and founder of SONA. During today's session, our guest panel will share best practices in managing credit card fees and taxation of employees' gratuities. Ron, Debbie, and Ryan will share insights and take your questions during the informative 1-hour webinar. So welcome to all three. And we're going to start with Ryan, followed by Debbie, and then Ron. So I will turn it over to Ryan. Thanks, Ryan.
Thanks very much for having me on today. I really appreciate it. Hello, everybody. Thanks for joining the call today. My name is Ryan O'Leary. I'm the founder and CEO of an Atlantic-based company called SONA. We are a payments and point-of-sale company with our head office here in Bedford, Nova Scotia. The company was really started based on my background. So I started in the payments industry in 2003, and I worked for 5 years with a very large payment processing company called First Data. I was responsible for all of the credit union relationships here based in Halifax. After about 5 years working with them, I moved over to JP Morgan Chase, or Chase Payment Tech, which is another large payment company partnered with Scotiabank. I worked 5 years with them on their small business team, and then 3 years on their mid-market national team. So we're more working on larger complex relationships, maybe like similar to like Sobeys or Tim Hortons. So the company actually was started in 2016, SONA. I made the decision to leave Chase to start SONA. The main reason that I made the decision to make the move was I felt that there was an opportunity in the industry as a whole to bring a higher level of transparency to local businesses, in understanding all aspects of cost. And also an opportunity to really improve the overall service experience that we would be providing customers. Obviously, from my experience working with the major providers, I felt that it was very kind of commodity driven, whereas where the industry is really going, we felt that there was an opportunity to kind of talk more about technology and more about education. So what I'm going to be talking about today, specifically around credit card processing, is in relation to a new change that has happened effective October, where the card brands Visa and MasterCard have reversed their position around credit card surcharging. My intention today really is to kind of lay out the information to all the attendees today, and our intention and the way we kind of treat things is that we want to make sure that with this type of new change that's happening, that everyone is really kind of adopting, or if they are choosing to go into an option where they would surcharge or pass on the cost of credit card acceptance, that they would be doing it in the most compliant way. So part part of the presentation, or part of the information that we're going to be going through is through some of the partners. So SONA, as an independent payments company, we actually have processing relationships with 3 different credit card processing companies. So we work with Fiserv, or First Data, which is one of the largest payment processing companies in the world. We also work with Elevon, which is owned by US Bank, and we are in discussions to add Mineris as a 3rd supplier as well. So a lot of the information I'm going to be sharing with you here is coming from Fiserv Canada, because as it appears right now, First Data or Fiserv Canada will be the first company that will have the technology embedded into their payment devices to be able to effectively surcharge or pass on the cost of acceptance. So I guess, the first thing is, where did this come from, and how did we get to where we are today? So the first thing to understand, I guess, when we look at in Canada and the actual overall cost of acceptance, specifically with credit cards, a large portion of the actual cost, or that percentage that you would pay on a particular card, is actually something known as interchange. Interchange is the fee that is actually set by the card issuing bank in conjunction with the card brands Visa or MasterCard. So when we look at these interchange rates, so as an example, say you're paying a rate of 1.3% for Visa, it's possible, like, depending on the industry, 90% of that fee is actually it's processed by your processor, but actually the largest portion of that transaction goes back to the card issuer. So as an example, a restaurant, the interchange rate for a domestic basic card would be 1.1%, and your processor charges you 1.2. They're making the 10 basis points in terms of profit, but the rest of it is going back to the issuer. If we look at the Canadian interchange rates compared to the rest of the globe, Canada has the 2nd highest cost of acceptance in terms of interchange, only to the United States. So although we've seen over the last 5 years that through organizations like the Canadian Federation of Independent Business or the Retail Council of Canada, although we've seen a lot of positive pressure, obviously, on the card brands to lower that cost, it has been coming down year after year after year. In the United States, where they still, and interchange is coming down as well, it is still considerably higher. So in the United States, 50 of 52 states allow for a traditional surcharge, or the ability to pass on a portion of the cost of credit card acceptance to the cardholder. So effective October, the card brands had made the decision to reverse their position to now allow businesses to choose. Where this stemmed from was a class action suit known as the Watson case, that was originated in Vancouver, a furniture store, where the owner proceeded to launch a class action suit against the card brands Visa and MasterCard, as well as the 5 major banks. And in that process, the main argument is that there was whereas a business would choose to be able to say, I accept Visa at this particular cost for one type of card, I agree to take that, but that shouldn't necessarily mean that I have to take another Visa card that carries a higher rewards or higher cost as well. So in the end, they were successful in winning that class action suit. It was a $188 million settlement. The card brands, while they didn't accept wrongdoing, they did arranged to make this settlement, and then part of that process was to change their position around surcharging. So I guess what I'd like to do is, our goal is to make sure that like any merchants or businesses that would choose to investigate these options, to let them know what those options would look like. So as of today, there are really two types of options. One is a traditional surcharge. So with a traditional surcharge, some of the requirements include that the maximum amount that you would be able to pass on to a cardholder would be 2.4%. So the second thing is that the business isn't permitted to profit from their surcharge. So some businesses, when they heard about this, came out and said, I'm just going to add 3% on. We're going to put a sign up at the, in front of the cash register, and we're going to charge 3%. That would, not fall into compliance because, it's possible that their effective rate, when they look at all the different types of credit cards, could be that is accepted, could actually be less than that 3%. So, so it's not permitted in Quebec. You can't also discriminate amongst different types of credit cards that are accepted. So although the cap on surcharging is set at 2.4, you don't necessarily have to charge the full 2.4. If we look at some of the major adopters, like TELUS as an example, that jumped on it right away, they set their surcharge at 1.5. So they're recouping some of their costs, but not all of their cost. You can't accept or you can't exempt specific transactions, meaning you can't say, I'm going to charge for the, a card not present transaction, but I'm going to charge there, but I'm not going to charge for when a customer walks in. So if you're, the big thing to know about it is if you choose that you want to go in the surcharge route, you're all in. So that means that you set the percentage, the processor sets their rate to match what you're going to be charging as a surcharge, and you're doing it 100% of the time. So you need to provide 30 days advance notice to your customers, and you also need to register specifically through MasterCard as a company that is choosing to do surcharging. So most of the payment processing companies that you'd be working with do have programs now or are setting themselves up so that they can communicate to MasterCard on your behalf. So, what are some of the advantages? I guess, the way our kind of position is that, with surcharge, the way this is going to be displayed, for example, on a physical point of sale, is it's going to very clearly define and say that, you're paying one cost if you're paying by cash or Interac, and you're paying a additional cost, as you can see on the screen here on the devices, where it shows an actual shows it as an actual surcharge. So this is also available for e-commerce merchants or businesses that are doing traditional invoicing. So it can actually be programmed into a line item and show up as an additional amount. So for us, I think that when we look at traditional surcharge and how it's being kind of positioned now, the economics are pretty easy to understand, and I'll go into that shortly. So the next type of option, and so and I guess the first thing I would let everyone know is this. The second option is called dual pricing or cash discounting. So the first thing that I'd like everyone to know is that dual pricing or cash discounting has always been legal by the card brands. So we see popular, like like gas stations that use it now, and the main difference with like a dual pricing or a cash discounting is that instead of showing a additional amount that the cardholder would have to pay if they were paying by credit card, the way that they would position it is that you would be paying 1% or $1 amount, and then if the cardholder would use another method of payment, that you would incentivize them to use it. So so this is called dual pricing. And so the nice, how it actually is positioned is it shows this on the screen. So on the actual device, it will present that, those various options. There's no requirement for you to actually, put a sign into your business, because what you're really doing here is you're incentivizing for the client to pay by a different payment method that has a lower overall cost, right? So the other thing with dual pricing is that you have the ability to use it when you want to or not, right? So it can apply to certain items versus other items. It provides a lot more flexibility, it kind of skirts around. There's the card brands. There's no requirement for you to actually notify the card brands, because you're not penalizing a customer by using for credit card processing versus debit or cash. You're more providing an incentive on the other way, right? So and this is, we feel like that what we're seeing for most of the market is this dual pricing. You will probably see an uptake of a variety of different companies approaching small business, utilizing this type of approach. And so how would it work in terms of math? So if we look at a traditional surcharge, if you were to choose to go into that type of program, we know the maximum available percentage that can be set would be at 2.4. And so, if you have $100 sale, you would be adding 2.4% to that transaction, the total amount. So your cardholder or the customer that comes in is going to visibly see that on the actual payment device, that $2.40. On the back end for you as the individual merchant, your credit card processing company will set a flat rate very similar to what Square does today at 2.344, which is really the pre-tax amount. And the credit card processor is now accepting 2.4, so the net settlement is 100, and you have that offset. So basically, the total cost of that credit card transaction is passed on. So if we look at a dual pricing example, the other thing, the 2.4 is gone. You don't have to. There is no cap. So you really, as the business, will have the ability to choose what incentive you want to provide, for using that other payment method, cash or Interac. So we've used this as an example at 4%, and you would see how it actually balances out to the $100, right? So there are as of today, there are very few companies that have the technology associated on their equipment or their debit machines to provide the option for either dual pricing or cash discounting, or traditional surcharge. We work closely with obviously with Fiserv Canada, which owns a product technology called Clover. You would probably many of you might have seen these or are using them today. These are white devices that are using an Android-based application that allow for third-party applications to be able to run on the device. And so there is an application on Clover currently that supports both dual pricing and cash discounting, and traditional surcharge as well. So And really how it works is at the, when the transaction is processed on the screen, prior to the card being inserted into the device, it will display the transaction amounts either in the way that you see on the screen now, where you're providing an incentive for debit or cash, and a flat amount for credit. It also can be programmed for the traditional surcharge as well. And once again, this is all kind of programmed on the device, and it can work either in a point of sale capacity, or it could work in just a traditional payments system as well. And that's kind of in a high level overview of some of the options. Does anybody have any questions?
I think we'll just do questions at the end, Ryan, for
Sure.
all three
perfect.
of you. Okay.
Great. So I'll just stop sharing here.
Great. And we'll move on to Debbie. Thank you.
Thank you. Thanks, Lynn. Thanks, Ryan. Get this up here. So my part of this presentation is to do with the EI and CPP on the tips. And what we're going to talk about basically for the next probably 10 minutes is the source deductions on controlled tips. I'm going to define, first of all, what controlled and direct tips actually are. Then we'll spend a few moments talking about the CPP minimums and maximums and how that affects the deductions you have to take from your employees. There are also EI maximums, but the EI is a much lower number, so it's not quite as exciting. We'll look a little bit at contribution rates, and then when do you have to file forms such as your source deductions and things like T4s. So the main thing to understand around this change, which came about due to a court case, which I presume Ron's going to be the one to speak about, is that there's two kinds of tips that we have to identify. The controlled tips are the ones that give the employer the most trouble, of course, because they're the ones where we have to record the amounts in our own books, take deductions when we pay them to our employee. So a controlled tip is one that comes through your payment processing system. You have control over it because it ends up in your bank account. You're effectively collecting this tip, and you're the one who pays it to the employee. So a controlled tip is the one where we're going to have to take deductions before we give that money to our employee. A direct tip happens when the customer pays the employee directly. So this is most commonly done if someone leaves cash on the table or hands cash, currency, to the employee. If the amount of the tip goes through your machines as a debit or a credit, then it is a controlled tip. If the tip goes directly from the customer to the employee, then it's a direct tip and it's not your problem as an employer. Of course, all tips are taxable. All tips have always been taxable, not a change. What my accounting practice, we do about 1,000 tax returns a year, and I probably get asked about 20 times a year, how much of my tips do I have to declare? And for every year that I've been doing tax returns, that number has been all of them. All of the tips are taxable. There isn't a percentage. That is some kind of a legend, I guess, that you only have to declare part of the tips. So when we have a control tip that goes through the employer's books, it's going to be on the employee's T4. So the employee picks up that income by reporting their T4. The direct tips are to be recorded by the employee on their tax return separately. And this, has been happening. The employee has always had the option to pay Canada Pension Plan on any direct tips that they report on their tax return. So that has been there. I have, clients who do that. They want to get the maximum CPP, so they report it on the direct tips that are not on their T4. So the actual source deductions, the EI, CPP, and income tax, a controlled tip is the same as any other remuneration. It is received by the employee by virtue of employment. It comes to them from their employer. It's going to be on their T4. So you are required to take Canada Pension Plan from the money that you give to your employee as their share of the CPP. And of course, you have to pay the employer share as well when you send your remittance to CRA. So you take the deduction from the employee, you match that in the case of CPP, and you send that to Canada Revenue Agency. EI, same different deal. You take the EI from the employee and you take, so if you take $10 of EI from an employee, you send that money to CRA. You also send 14 of your own dollars to CRA because the EI is set up as 1.4 times whatever the employee pays. So the maximums for CPP for 2023, the maximum contribution that is made to Canada Pension Plan in 2023 is based on $66,600 of income. The minimum is $3,500. So anybody whom you are paying less than $3,500 a year, you do not have to take CPP from any amounts under $3,500. As well, once that income is over the $66,600, you no longer take CPP from that person. They have maxed out. The CPP rate for 2023 is 5.95% of the actual remuneration that is being paid to the employee. And that means that the maximum contribution is $3,754.45. So if you take $66,600, subtract the minimum, multiply it by 5.95, that's the number you get. And of course, that's the amount that comes deducted from the employee if they made that much money. And that's the maximum employer contribution as well. So the most that CPP can cost you per employee, which is still a lot of money, is $3,754.45. EI is simpler. It's also less. There's no minimum for EI. Every dollar that is paid to an employee is subject to EI. There used to be a rule where people who earned or who worked less than 15 hours a week weren't allowed to contribute to EI. And that led to fairly widespread abuses where companies like Sears had a whole fleet of part-time employees. Everybody worked 14 and a half hours a week. Nobody paid into EI. So employees had a number of part-time jobs and no EI coverage. So those rules were changed. There's no minimum for EI. You pay somebody, you've got to take EI from that payment. So the maximum contribution for 2023 is based on an employment income of $61,500. The EI rate is less, it's 2.282%, and the maximum contribution by an employee is $1,002 this year, 45 cents, and the maximum for the employer is $1,400. Right. So you must, of course, remit EI, CPP, and income tax by the 15th of the next month. It is possible to be a quarterly filer as well. You need a perfect compliance history and permission from CRA. So I've just based this on monthly. The EI, CPP, and income tax has to be paid to CRA by the 15th of the next month. The CPP is, you just double what you've taken from the employee. The EI is 1.4 times. So there's penalties, of course. In fact, CRA has an entire department of penalty calculators down there because it depends on how late your payment is. So if you are a day late because you got to the bank after they closed or after they stopped dating things today, then the penalty is 3% of the amount that you owed. If you are more than 3 days, but less than 6, it's 5%, 6 or 7 days late is 7%. And after you're a week late, the penalty is 10%. So the issue here, of course, is that if you didn't think you were supposed to be taking deductions, either because you thought somebody was a subcontractor or because you didn't think tips were eligible for the deductions, then you're going to be more than 10 days late. And the penalty then is 10%. And as you know much about CRA, they calculate their penalties and then they compound the interest on them every day. So if you are 4 months late, that interest has been compounded every day for 4 months, which does mean that it adds up for sure. So besides the source deductions, there's other forms to do with payroll. We're talking about the T4s first. T4s have to be filed by February 28th of the year following the year in which you made the payment. So we just had that deadline. That was last Tuesday. All the 2022 T4s had to be filed by the end of February 28th for 2022. So if I recommend always that you do your T4s early in January, because the last time you have to make a legally on-time payment for the year is by January 15th of next year. So we try to get all our T4s done before January 15th, because if you find out you've got a shortfall in EI CPP, then you can make that up on your January 15th payment, and CRA need never know that you were short paid during the year, unless they come and do an audit, in which case they'll figure it out. So you should do your T4s early to make sure that you've got the right amounts on the T4s, that you've sent in the right payments. There's also a requirement that you have a form TD1 on hand. You don't send it with the T4s, you don't give it to the government, but you should have it on file. And I would suggest that you get that done as soon as you hire someone. The issue being that sometimes employees don't last for more than a few days, your choice or theirs. And when it comes time to do the T4 later on, you don't have their social insurance number, or you don't have their correct address or birth date. And that can be a problem, because CRA has the ability to say that a T4 that was filed without a social insurance number on it isn't validly filed, and then they can charge you a penalty on having late filed your tax return. And the minimum penalty for filing a T4 late is $100, but it goes up by the number of T4s you have. So if you have more than a couple of T4s and you're late, the penalty can get as high as $25 a day. So we do not ever want to file our T4s late. We don't file anything late, because as soon as you do that, there's a late filing penalty. Okay. So what did I talk about? Source deductions are only on controlled tips, the ones that the employer has control over because they come through your system. The direct tips, that is the employee's conscience to declare that on their tax return. We went over the CPP minimums and maximums, so you know your maximum exposure if you didn't realize before that CPP and EI were due on remuneration. And we talked about the filing deadlines. That's it for me. If you're looking for me, that's my email address, debbie@peverill.ca. What I'm talking about today is my painless financial training group, but I run an accounting practice as well called Peverill Associates. All right. I will stop sharing and move on to Ron.
Great. Thanks, Debbie.
Welcome.
Ron, did you have a PowerPoint?
I don't have a PowerPoint.
Perfect.
But what I do, I can't share. Well, I do have a mind map, but
Okay.
so I don't know if you guys want to see it, but I can surely share it. Hold on here. Here we go. Share. And this is I don't know if this is my mind map of, I was looking at the specific issue of what is a control tip and what is a direct tip. And specifically, whether with credit card, debit card payments, is it the case that in every time that the employer collects the money and then gives it to the employees, is the fact of collection a controlled tip in and of itself? And what I want to show you is what Revenue Canada said in 2020. They had a circular, and this is what the circular, right? Which I can't seem to, anyways, can't seem to open now that I'm sharing my screen. Let's see here. Anyways, there was a subset of tips that were paid directly that the Revenue Canada in 2020 said that were not controlled tips, though they were received by the employer. And those were tips that were paid by debit or credit and which were turned over to the employees the same day, or if there was a cash flow problem, the next day. And the issue in every case, it used to be on whether something was a direct tip or a controlled tip, was whether who controlled the payment. So by that it means if the tips were just directly handed over to the employees and they decided how to distribute it, because sometimes they tip share with non-tip staff, like servers or kitchen staff, then in those circumstances, if it was the employees themselves who made the determination of whether to pay out the tips, they considered those direct tips and not controlled tips. And there's one case here, this one, BAG Hospitality Inc. versus Minister of National Revenue. It's a tax court decision of 2008. This company, BLAG, bought a restaurant. There was, when they bought the restaurant, there was a pre-existing tip arrangement, which they continued. So the way it worked is that the servers kept 100% of the cash tips. The debit and credit card tips were split 70-30 with the bus and kitchen staff. And the way they were paid out is at the end of each shift, the employer gave a tip report to the hostess. The hostess calculated how much was due to each person. And the following day, the amount would be paid according to the tip report prepared by the hostess. And in that case, it was held that that money received by the employer was not a controlled tip, but was a direct tip. And the court's reasoning, the tax court's, was that, first of all, that this process was not instituted by the employer. It was not part of the employment contract, and the company was just a facilitator. So it used to be that if you received tips as a result of clients leaving money on debit or credit card, and you just, as an employer, just facilitated the payment to the people to whom it was entitled, then those tips were not controlled tips. They were direct tips, which had a whole bunch of consequences. First of all, they were not considered income for purposes of EI or CPP, and the employer didn't have to take that money into their income. So that's for many years, and that's consistent with the 2020's information circular put out by the Revenue Canada. That's what they said. That's what seemed to be what all the case law was saying. And you can say I have some other cases, 2019, similar reasoning in the RC versus Canada Employment Insurance Commission. And in 2011, in this Popo Garden Limited and MNR, that was another tax court decision, followed the same rules. And then comes this case, Restaurante a Mano Limited versus Canadian National Revenue Agency, 2022 Federal Court of Appeal. And this seems to have changed, or appears maybe that it changed everything. So in this case, tips were paid according to a formula. The formula was that the servers kept their cash pay, but so the credit card and debit tips went to the employer. The employer deducted 1% of net food sales and paid it to kitchen staff. So it's not 1% of tips received, it's 1% of net food sales. And 2% of the tips received this way were deducted for electronic charges. And then the remaining cash tips, and then the remaining tips were paid out to the employees. And what the Amano, Restaurante Amano, argued is that this was a direct tip, not a controlled tip. And of course, there's some elements of this payout, like the 1% net food sales to kitchen staff, that may have changed the tip to a controlled tip where the employer is deciding how to pay out the money. But what the court did is it said, well, this idea of controlled and direct tip is kind of not relevant. What is relevant now is the amount, and you can say here, is the amount paid in respect of employment? In other words, but for the employment, would the servers have received the tips? And then they go into their reasoning. And in paragraph 41, they say, to be clear, in determining whether tip is an amount paid by an employer and whether the amount is respective of employment, factors such as when the amount is paid, daily, weekly, at the end of a pay period or some other period, whether the employee is paid all or some or portion of their own pooled tips, whether the employer keeps a portion of tips, or whether the tips are distributed under a collective agreement, a written agreement, an oral contract, or otherwise may be of little or no relevance in a particular case and are not determinative. And that is inconsistent with the information the government put out in 2020. So now, if you read this case, it seems to be suggesting that as long as the money goes to the employer, it's always going to be something that the employer has to include in their income. And this distinction of controlled versus direct may not be so relevant. It's whether the amount was paid in respect of employment. So if you, the employer, you receive a tip because the tip was added to the bill, it's considered your income, and you pay it out to the employee, the person who served, and they say, well, but for that working there, the employee would not have received that money, then it's money paid in respect of employment. It's going to be interesting to see whether subsequent decisions are going to follow what Restaurant Romano decided, which seems to be inconsistent with what previous decisions decided, whether they're going to distinguish it on the facts and say, well, no, this is really a controlled tip situation, and this court was speaking too broadly, or whether this is a signal of how things will be dealt with. But I think when you go talk, when you go figure out what your obligations are, I think that the safest bet after reading this case, which just came out in 2022, so it's a very recent case, I think it was October of 2022 came out, is to treat all the tip money you receive on clients, on customers' bills, whether they be debit or credit, treat them as income, so that when you pay them out, they're subject to CPP and EI, as Debbie suggested. The other interesting thing to note, though, is that we have to look at under what circumstances it's not every statute that treats tips this way. So, for instance, if you look at labor standards and there's a lost wage claim, the Labor Standards Code of Nova Scotia, at least, is silent on the issue, but seems to suggest in their circulars that they don't consider tips as part of income. So that's going to be interesting when a new claim comes from, let's say, a server or an individual who's entitled to tips who was terminated, and they say without cause. It's going to be interesting to see whether, in light of this decision, labor standards in Nova Scotia, for example, may change their position on whether tips are to be considered income and part of the calculation of lost wages from, for instance, a wrongful dismissal. So those are, subject to any questions, those are the comments I want to make on this. Thank you.
Thanks very much, Ron. And we do have one question from John. So the definition of control tip is completely different from what we had been advised previously was a control tip as defined by CRA. So I'm not sure, this may have already been answered. Has CRA officially changed this to now include tips that go through our payment system? So I think, Ron, you may have covered this. Previously, the definition allowed for tips paid through our payment system to be paid out immediately to the employee and not be considered controlled tip.
Right. So what I will tell you, that was the position, that seemed to be the position for many, 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 many years. And this Federal Court of Appeal decision in October 2022 may have changed all that.
Yeah.
So yeah, go ahead.
Sorry, Ron. What we've heard from CRA basically is that the court decision supersedes their information because it's more recent. And I mean, on a personal note, I've yet to see CRA turn down an opportunity to gather more money. So if the court is suggesting that, you know, there's going to be EI and CPP taken on tips, I don't think CRA is going to say, oh no, we're going to pass new rules to change that court case. So the accounting profession in general has taken the attitude that's a change, and we need to send in the money on the EI and CPP on tips. So, you know, that as you say, that may change with subsequent court cases, but we've taken that one as definitive. So.
Thanks, Debbie.
It is a Federal Court of Appeal is of a greater authority than Tax Court of Canada or the other decisions. So that is the law that you should be guided by at this moment.
Thanks, Ron. Do we have any other questions? I was going to say that kind of sums it up with the court case, doesn't it?
That's all she wrote.
Yeah, I was going to say it's pretty cut and dry.
pretty, well, you know, they kind of, if you read it, I mean, from a legal perspective, it's kind of waffly language. It's kind of this, kind of that, kind of, you know, blah, 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 blah. Sometimes you get, I don't know if these judges understand, well, it doesn't matter whether they understood what they were doing or not. They just did it. They changed the world in one stroke of a pen.
Yeah.
And that's all there is to it for right now. That's the practical implication. But whether other, and who knows if there will be a decision sometime or whatever it might happen. Another Court of Appeal decision, it could come back and say, well, you know, restrict the impact of this decision because of the waffly language the judges use, which didn't seem to follow the controlled, like they talked about not controlled and direct. They had other language. They were talking about distribution or a conversion, you know, so they weren't even using the common language that's used in all the circulars, all the cases. So, but doesn't matter. It is what it is.
No, I was going to say it's not cut and dry for our industry, but in terms of it being there, it's cut and dry.
Follow your accountant. 100%.
Yeah, when in doubt.
That's right.
Choice, you know, because the question that has always been in our minds is tips are definitely earned by virtue of employment. So there's no argument around that. So this other distinction around controlled or direct doesn't affect the income tax situation, but yes, it does affect, you know, CPP and EI. But it seems to me that it's going to be sound rules. It's definitely virtue of employment.
Yeah. So here's the question, like this lawyers like the legal question, and I'll tell you what it is. Cash tips are earned by virtue of employment. You're not going to get a cash tip if you don't work there. So why isn't the cash tip income?
It is.
So maybe employees have to hand back all their cash tips to the employer so they can do all the CPP. And so that's the problem with this decision, right? It just creates more questions than it answers because it upset the world. So I'd be leery as to whether, you know, are they going to reach back and say, oh no, all those cash tips they got, they should have given it back to you and they got to pay CPP and EI on it. But the employer's going to say, well, I never got it. And is that the distinction? But that doesn't make sense because then you're introducing a different test than earned by virtue of employment.
Right.
There you go.
I mean, I do believe that people receive tips and don't declare them, right? So that's always, you know, that's been a hole in the system. But CRA's always had the position it was taxable. It's really just an administrative policy if they're going to have one around the difference between direct and controlled. But the court case said direct and controlled didn't matter. But then what's the mechanism though for collecting EI and CPP on a direct tip? Like you say, you know, are we supposed to self-assess? Yeah. But so what we're doing as an accounting profession to keep our clients out of trouble is putting the EI and CPP on the controlled tips and making sure that those amounts are on the T4s so that people don't have penalties and interest and, you know, bad CRA outcomes. But whether there should be, you know, anything else being done with the direct tip EI and CPP, we were leaving that one alone. But you're not wrong. I mean, it's not different.
No, yeah. So it's difficult, right?
Yeah, for sure.
Yeah.
But it'd be hard pressed to control those cash direct tips.
Yeah.
Yeah.
So that,
I think that's why they had direct and control in the first place, right?
Yeah.
Provided some certainty, provided everyone knew what the rules were and it made sense. But then they went back and changed. I mean, that's what a decision can do. It can create uncertainty, whether there was certainty, right? So where there was, right?
Yeah.
and it's particularly annoying when you've got stuff that's still on CRA's website from 2020 talking about direct and controlled tips, and yet we all know this court case has happened. So, you know, they haven't updated their information on their own site in light of. However, I don't usually suggest people go directly to CRA for information anyway, but however.
Do we have any other questions before we wrap up? We got a good panel here, so this is the time. Okay, I am not seeing any. Okay. So on behalf of TIANS, I would like to thank Ron, Debbie, and Ryan for joining us this morning. We have recorded this session and we'll make it available early next week on our YouTube channel. And Ron, if you want to send that lovely map to me, I have a feeling that everybody would really like to have that and read that full case. We hope you can, thank you very much. We hope you can join us tomorrow morning for our next webinar, which starts at 9:30, and it's on diversity, equity, and inclusion, business imperative presentation for leaders. Registration is still available through social media, or you can email me at lynn@tourism.ca and I will send the link out to you. So thanks everyone once again. Have a wonderful snowy morning. And Debbie, no comment. Enjoy the sunshine for all of us and the warmth while we continue to shovel and shovel and shovel in the month of spring.
Yes, we all make our own choices, Lynn.
Yes, we do. And I'll leave for the airport right after I hit end, and that's my choice. So thank you for your inspiration, Debbie.
You're welcome. Thank
I'll
you.
blame it on you.
Yes.
Thanks again, everybody. Have a great day.
Thank you.